Good morning, this is Bloomberg Daybreak Europe. Happy Thursday. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks gain after weak US private payrolls data lifts the odd of a Fed rate cut next week. An auction of Japan's 30-year bonds draws the strongest demand since 2019. French President Emmanuel Macron meets Chinese President Xi Jinping in China, with both leaders calling for increased cooperation between the two nations. And President Trump says a meeting between his envoys and Vladimir Putin was reasonably good as the Russian leader prepares to arrive in India to meet Narendra Modi. So by the close of play on Wall Street yesterday, a really fascinating picture emerging with pretty modest gains for the S&P 500 and the Nasdaq 100. But it was the Russell 2000, the small caps, powering to gains of almost 2% by the close on those rate cut expectations on the ADP private payrolls data that showed that deterioration in the jobs picture in the US. Markets now pricing, swaps traders now pricing a more than 90% chance that the Fed goes with a quarter-point cut next week. European futures then set for a fourth straight day of gains if things come through. The gains have been modest, but you are still seeing that very, very modest momentum. It does continue, and particularly a fourth day today. European futures point to gains of 0.6%, so set factually for one of the strongest sessions in the last few days. FTSE 100 futures looking to add 27 points here in the UK. S&P E-minis flatlining after modest gains yesterday. Nasdaq 100 futures pointing a little lower by 15 points. Let's flip the board and have a look cross-asset then. Treasuries, of course, in focus on those rate cut bets. 408 right now on the benchmark US 10-year, with yields up almost 2 basis points. So there's a little bit of selling pressure across Treasuries, but that, of course, in the context of the gains for Treasuries in recent days on those expectations of lower rates stateside. Stronger dollar is part of the story with higher yields, of course, so it's putting a bit of pressure on the euro today. 116 on the single currency, just down 0.1%. Brent just below $63 a barrel, and copper now back below 11,500. Goldman Sachs saying that the recent run-up, and you've seen these record prices for copper, is not based on fundamentals. Goldman Sachs says it doesn't think there's much further to run for copper at these levels. Currently, it's down 0.2%, but that is nonetheless a fascinating story on the demand, of course, for that input metal. Let's cross over to Asia right now. Bring in Winnie Su, standing by for a check on the Asian markets. Winnie.
Yeah, morning, Tom. Today's big highlight is definitely the Japanese assets, and we're going to start with the bonds because we've got that solid demand coming from Japan's 30-year bond auction. And here you can see that markets reacting to it with a 30-year yield down about 4 basis points at one level and stabilizing a little bit here right now. And it comes after a solid bond auction demand from the 10-year bond auction earlier this week as well. And it really goes to show how investors' appetite remain quite strong after yields really coming to that record high levels, and investors are becoming more positive around that area. However, it also comes to provide a bit of a relief, especially after that big recent sell-off with the concerns around Takaichi's policy and also bets on the Bank of Japan to raise rates. Now, we also take a look at what's going on in the stocks area, because Japanese stocks here also outperforming regional peers. You can see that overall Asian stocks up just slightly less than 1%, driven by that bet around the Federal Reserve to cut rates. And here, Japanese stocks, the benchmark topics is actually up slightly less than 2%. And investors are telling us that it's because Japanese stocks are a bit more sensitive to the moves in the U.S. and also the moves from the Fed. And also, today's slightly weaker yen is also helping exporters in the region. Now we flip the board and take a look at what's going on in the currency space. And for currency, today's highlight is the Chinese yuan. And that's because today we have that PBOC fixing at its weakest bias since 2022. And we see a bit of a weakening when it comes to the yuan. And that's because we're seeing a bit more signal for the PBOC to lean against the appreciation of the yuan. And that is really been driven by that appreciation of the yuan recently has really been driven by the easing tensions between U.S. and China and investors buying more of Chinese assets recently. But for now, investors are expecting the yuan to strengthen for the near future.
OK, the currency impacts of the geopolitics and the easing of tensions, as you say. Winnie Su in Hong Kong, thank you. And talking of geopolitics, Presidents Emmanuel Macron and Xi Jinping are meeting in Beijing as part of a 3-day visit for the French leader. The pair are expected to discuss a range of issues from economics and trade to Taiwan and the war in Ukraine. Let's bring in our China correspondent, Min Min Lo, at this point. Min Min, how has this visit progressed so far? What has stood out to you is Macron. Macron and Xi Jinping, are they looking happy? Have they made any deals? What's going on so far?
Yeah, I mean, you saw the pictures just now of Macron inspecting the guards there, and he spoke to President Xi, I believe, for over an hour this morning, and we saw live footage of the two sides signing some documents as well. We understand that they have signed 12 cooperation agreements ranging from areas like natural resources, something that is very closely watched given that, France have been pushing for the easing of those critical minerals excess, right, for Europe. And then they also signed cooperation agreements when it comes to investments, when it comes to infant milk products, social benefits, and aging. And I think what is important to watch as well is some of the other business deals that could be on the table, because France brought, Emmanuel Macron brought with him a delegation of business executives as well, including the head of Airbus, and we know that a Chinese leasing company is looking to negotiate for a fleet of planes from Airbus. He also brought with him the head of Danone, the food processing company, the head of Rémy Cointreau, which is a French cognac company, and that tells you that Emmanuel Macron is still hopeful or hoping to push back on some of these tariffs or put probes into certain sectors, and he said he is making progress on the export of agri-food to China, and I think one of his goals is to manage that trade imbalance that France has seen, right, over $50 billion in trade deficit that we saw last year.
Yeah, well, that has been a long-running issue, hasn't it? And so far, China hasn't made any significant moves to reduce that. What is top of mind for the Chinese leadership at this point? What do they want to extract from France above and beyond the deal-making?
Yeah, I would say overall the issues that we're looking at, you can separate them into two buckets, right? Geopolitics is one, so for China it will be Taiwan, and for France it is the Ukraine issue. But geopolitics is where I think we see very little room for negotiation given the strategic alliances that we have seen here. But on the other bucket is the trade issue, right? And I've listed some of the areas, the tariff issues that France might be interested in, but China, I think, will want to see more friendly business environment in France as well. You think about companies like Shein and how that company has opened up an offline store in France, but it's faced so many resistance from, class action lawsuits from French retailers to protests as well. And the French government at one point wanted to suspend the online platform over allegations that is selling childlike sex dolls, although that suspension is now being halted for now. But I think overall, both sides are looking for better business environments for each other's businesses.
Bloomberg's China correspondent, Min Min Lo, thank you very much indeed on that presidential visit. Of course, the French president on the ground in China, and that visit continues with stops outside of Beijing. I believe he's going to Chengdu as well, home, of course, of the Sichuan panda. Now, US companies shedding payrolls in November. It's not just the Sichuan panda, it's a panda, but it's in the province of Sichuan. Val is laughing alongside me. Great food in Sichuan, by the way. Payroll data then out of the US. How concerned, Val, should we be? ADP numbers coming in, the weakest in terms of the most jobs shed since November of 2023. Are we starting to see a real kind of breakdown of the labour market and jobs in the US?
Well, look, it was an unexpected contraction in the ADP. It's actually now the fourth time this year that the ADP metric has shown contraction. It's the worst contraction this year. So down 32 jobs is what the survey showed yesterday. And if you're looking
32,000, down 32,000.
32,000,
okay.
Yes, excuse me. If you're looking for weakness and something to point out, it was especially weak and pronounced when it comes to small businesses, which ADP classifies as a business with under 50 employees. Those companies shed 120,000 jobs in the month of November. And that's important, Tom, because we know that small businesses in the U.S. are really the growth engine of domestic growth. So it seems like small businesses are struggling more than the big players. But overall, the fourth time the ADP has shown contraction this year. And again, in the absence of the November non-farm payroll report, which we were due to get tomorrow. The market had a bit more focus on this ADP release yesterday. We're now nearly pricing in certainty of that Fed cut next week. It's around 98% on the warp function on the terminal. It did spur some weakness in the dollar yesterday as well. The dollar fell by nearly 0.4%. Its worst session in 3 months. There hasn't been a lot of volatility in FX lately, so a move like that does have that kind of superlative. But on the back of this, we did actually see, as you mentioned, small caps outperforming. So again, the flavor of the market has been that we've not necessarily gotten data so bad that we're worried about a recession. It's data just bad enough to keep the Fed cutting, and that is something supportive for the equity market.
All of this happening at a time when the Treasury Secretary, Scott Bessent, is potentially going to be expanding his remit at a time now where we're starting to see some challenges for this US economy. So I wonder how that all ties in. What do we know about potential additional responsibilities for Scott Bessent?
Yeah, Bessent making the headlines for various reasons yesterday, one of which is that sources have told Bloomberg that he is being considered for the director of the National Economic Council. Now, this is a seat that will be vacated if Kevin Hassett goes and moves to the Fed chair next May. It would help Bessent consolidate the oversight of Trump's economic policy. So both in the White House and the Treasury, it would give him an office in the West Wing, so even more proximity to the Trump administration. And I think what this tells us is two things. One, how key Bessent is to the Trump administration with potentially taking on a second role. And secondly, it's just another signal about how seriously Trump is considering Kevin Hassett for that Fed chair position. He did tease it yesterday. Again, the fact that he could make that announcement as soon as early as next year. We did have some concerning reporting from the FT saying that they've spoken to some senior bond investors who are less happy about this move to have Hassett take over the Fed chair. Some of them are not as keen about how close he is to the U.S. president and the U.S. president's economic agenda. But that aside, we're really tracking Bessent's next steps because in some way, at least recently, he has been foreshadowing that there could be some different changes at the Federal Reserve. He's really stepped up his criticism of the regional bank presidents. Yesterday, it was criticism of the fact that they are not from these regional bank regions. Instead, some of them come from the New York Fed. Some of them even live in New York City instead of in the regional areas. And that, for him, is not how the Fed should work. The regional presidents were really imposed to break the Wall Street groupthink, to break the New York Fed groupthink. So he's not happy. And in some ways, he was foreshadowing that perhaps there could be some changes, some new residency rules that would require these regional Fed presidents to actually live in their congressional district for around 3 years before becoming president. Now, he did concede that something like that would need congressional approval, but I think it just overshadows that not only are we going to get a new Fed chair, but there could be some reorganization in how the Fed works.
I think I did assume that the regional Fed chairs would actually be living, at least be living in their district.
Yeah.
So that is interesting. Val, thank you very much indeed. Valerie Teitel, of course, on some of the movements, potential movements for Scott Bessent and the focus on those Fed regional chairs. Coming up, surprise data then out of the US, fueling, as we've been discussing, expectations for a Fed rate cut. We're going to be discussing all of that next with our next guest, Joyce Chang. How to position then. JP Morgan, Global Research Chair, a fantastic voice on all these topics. That's coming up. This is Bloomberg. Welcome back. We have some breaking lines from Rio Tinto, of course, the miner with a focus on iron ore, but other assets as well. It's their capital markets day. We're getting some updates. Rio Tinto seeing 2026 iron ore sales 100% iron ore sales. I'll get some more detail in terms of their divestment plans, because Rio Tinto is saying it seeks to divest assets that do not meet its investment thesis. They're seeking to release $5 to $10 billion in cash proceeds. And they see midterm CapEx guidance 2028 and beyond reverting to less than $10 billion. So that's the guidance on CapEx. And then the focus on divesting some of their assets. 4% reduction in unit costs. They see a 4% reduction in unit costs from 2024 to 2030. So trying to paint a conservative picture and CapEx and costs as well. So they see a 4% reduction in unit costs. And again, they're seeing an opportunistic This is how they describe it. Release of 5 to 10 billion US dollars from the existing asset base. So we'll get more details on this. It is the Capital Markets Day for Rio. That stock is up about 20%, a little over 20% year to date. We've got more details from our reporter on this and what it all means, of course, for anyone exposed to that stock in the next part of the show. Now, expectations. Let's step back and take a look at macro policy, because expectations of a Fed rate cut are higher after US companies shed payrolls in November by the most since early 2023, adding to concerns about a more pronounced weakening in the US labour market. Joyce Chang, JP Morgan's Global Research Chair, joins me now. Joyce, fantastic to get your insights. Let's start on the Fed. I know you got views on Europe and you've been meeting with clients and you have a feel on the ground for what's happening there. But let's start with the US and what your current expectations are in terms of how the Fed adjusts, not just in December, but into 2026 as well.
So I think 25 basis points, which is priced into the market, is coming in December, and another 25 basis points in January. And then you see the Fed on hold. And you could even be talking about, rate hikes from the Fed by early 2027. So I think the near term, we see a disconnect between the economic data and the weak employment data. So I think 25 basis points through December is something that's been signaled pretty well and is well within expectations. But it's not a huge cycle. There's another cut in January, but then hold for the rest of 2026.
That's really interesting. That's a slightly more hawkish take than some others are suggesting. So a cut in December, a cut in January, and then you get a hold. Is there an equity market risk around that view, or the equity market can live with that, given the fiscal stimulus that's going to be coming through from the US, from the tax bill and other support measures, or is a Fed that's on hold post-January something of a risk to the equity markets?
No, look, I think the businesses have gotten used to working with 4% interest rates, and we're still looking at earnings growth for 2026 and even looking into 2027, which is going to be double digits, earnings growth. But I think the real issue is inflation. This is going to be the fifth year that you're missing the inflation target by a wide margin. So inflation remains very sticky here. The employment data has been weak. But if you look at the growth data has been very strong. A lot of that support has really been the wealth effect that we've seen from such strong equity markets.
Is next year the year when the valuation story around AI really gets tested, do you think, Joyce?
I don't think so. I still think that we're pretty early cycle in this. And if anything, we see a broadening of the AI story. It's not just on the tech sector, but it's how AI is affecting logistics and healthcare and other sectors. So I see a broadening, but you also just see still a shortage on the data compute. So when we look at what's in the pipeline for the next 2 years, if you look at just the business investment piece of it, I mean, that story is very compelling. We're looking at, $500 billion from some hyperscalers that is already in the pipeline that we can look at. And if you look at growth this past year, about a third of global growth in the first half of the year came from the AI business investment. So I think that story is still very much intact going into 2026 and even into 2027.
Joyce, I want to get your views on Europe then. I know you've been meeting with clients, of course, and you're currently on the ground in Frankfurt. How does the European story evolve in 2026? And is there a risk that markets and investors underestimate the political fragility of Chancellor Merz and a coalition that's been described as being deeply under pressure right now?
Well, look, I think Europe, the ECB is actually in a good place where they're at 2% and very comfortable with that. We also look at faster growth that's going to be forthcoming and somewhat lower inflation. So I think the European equities have actually been a laggard here. We're looking at earnings growth in Europe that could be around 13%. There will always be an eye on the politics here, but I think the fiscal stimulus is one that is going to come into play right more and provide support. So I think if anything, there is more of a reason to think about that the U.S. isn't the only story, AI isn't the only story, to look at Europe in 2026. Particularly looking at the laggards, because we have had such strong market performance. So you had very strong performance in Europe on the German fiscal announcements, and then a real lag for the last 6 months. And I think that some of the pass-through from the ECB will be forthcoming, and some of the growth numbers are actually going to look better here.
OK, that's really interesting. And that 13% earnings growth call as well for European stocks next year. What assumptions are you making about the euro with that view, Joyce? Because the euro strength has been has been one of the factors holding earnings below their US counterparts this year. At least that's been the view from some.
Look, we still think that you're in a cycle for, dollar weakening, for more bearish dollar, but you've been sideways the last few months. So I don't see that as the bigger factor here. I think that the fiscal impulse really, outweighs on that. And you're beginning to see that really feed through into the CapEx numbers. So we're looking at euro dollar that will, over the course of 2026, move to 120. We wouldn't change that view. I think there is still a lot of focus on the U.S. Fiscal deficit. That the Fed is going to be able to cut in December and January, but not that much more. And I do think, as I mentioned before, that the ECB is in a very good place right now.
Joyce, before we let you go, you are short oil, but you're bullish on gold. Can you unpack that view for us?
Well, oil, it's really a supply story. There is just a tremendous amount of supply that's coming online, and we've seen stockpiling by China. If you had not seen China stockpiling so much on the oil, I think oil prices here would be lower. I mean, we're looking at oil that is structurally going into the 50s over a horizon of the next 18 months or so. But taking a look at gold, there is still a very strong structural story there, both on the demand side and on the the institutional support, as well as the support that is coming from central banks as well. So we're looking at gold going to 5,000 in 2026.
Gold at 5,000, 2026. Oil potentially at $50 US, and the S&P 500. Here's the view then, the S&P 500 to end of 2026, 7,500. JP Morgan Global Research Chair Joyce Chang, always really appreciate your insights, Joyce. Thank you for taking the time. Coming up, we'll switch to AI with a deeper dive on what's happening within semiconductors. Nvidia CEO Jensen Huang saying US tech firms should not give up on the Chinese market. We'll have the details next. This is Bloomberg. Nvidia is on the verge of securing a massive lobbying win after US lawmakers kept a measure out of must-pass defense legislation. The so-called GAIN AI Act would require chip makers, including Nvidia and AMD, to give American customers first dibs on their powerful AI chips before selling in China and other arms embargoed countries. Sources say this measure is not included in the defense bill, though the situation could still change unexpectedly. It comes as Nvidia CEO Jensen Huang met with President Trump at the US Capitol. Huang told reporters he's unsure whether China would accept the company's H200 AI chips should the US relax restrictions on sales of the processors. At a separate event in Washington, Huang urged the US not to give up on the Chinese market.
Going toe-to-toe against anyone, the American technology industry has nothing to fear. We are mighty, we're fast, we're inventive, we'll take anybody on. In the case of China, we shouldn't concede the entire market to them. They're formidable, but conceding that entire market, we ought to go compete for it.
Meanwhile, Salesforce has issued a better-than-expected revenue outlook for the current period, suggesting the company is successfully persuading customers to adopt its AI tools. The software provider expects revenue of up to $11.2 billion for the period ending in January. And Bloomberg has learned that Meta has poached Apple's most prominent design executive as the owner of Instagram, and WhatsApp accelerates a push towards AI-enabled consumer devices. Alan Dye had run Apple's user interface design team since 2015. Sources say it's replacing Dye with longtime designer Stephen LeMay. Also reports from the FT that Meta is being scrutinised by the European Commission around WhatsApp and integrations of AI. Coming up, Trump says the meeting between his envoy, Steve Witkoff, and Vladimir Putin was, quote, reasonably good. We discuss what is next for peace talks. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. Happy Thursday. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks gain after weak US private payrolls data. lifts the odds of a Fed rate cut next week. Meanwhile, an auction of Japan's 30-year bonds draws the strongest demand since 2019. French President Emmanuel Macron meets Chinese President Xi Jinping in China, with both leaders calling for increased cooperation between the two countries. And President Trump says a meeting between his envoys and Vladimir Putin was reasonably good as the Russian leader prepares to arrive in India to meet Narendra Modi. To the markets then, European futures pointing to a decent session this Thursday. It would be 4 straight days of gains, modest gains, but nonetheless the futures picture stronger than we've seen in recent days for Europe, looking to add to the gains that have come through. The session on Wall Street was intriguing, with modest gains for the S&P 500 and the Nasdaq 100, but it was the Russell 2000 that stormed higher by almost 2% on those Fed rate cut bets. Now European futures pointing higher by 0.6%. FTSE 100 futures in the UK looking to add 27 points. S&P EMEs are flat, as are Nasdaq 100 futures. Let's flip the board and have a look cross asset. A little bit of selling across treasuries, but that's after recent gains, of course. Markets are pricing in almost more than 90% chance that the Fed does cut next week. 4.08 right now on the benchmark 10-year. The yields up almost 2 basis points. Euro dollar at 116 on stronger dollar, down 0.1% then for the single currency. Brent at $63 a barrel, gaining 0.6 in the session. And copper back below 11,500, down 0.4%, but notching that record high. Goldman Sachs warning that the fundamentals do not justify the current pricing for copper. That is one view, at least, from the team at Goldman. Now, Donald Trump says a meeting between his envoy, Steve Witkoff, and Vladimir Putin was, quote, reasonably good. But the president acknowledged he does not know what the outcome will be after successive rounds of talks over a deal to end the fighting in Ukraine.
President Putin had a very good meeting yesterday with Jared Kushner and with Steve Witkoff. What comes out of that meeting, I can't tell you, because it does take two to tango. You know, Ukraine, I think we have something pretty well worked out with them.
Let's bring in our Russia government editor, Greg Sullivan. Then, Greg, what has the reaction been to Trump's comments? I mean, he often comes with the superlatives when it comes to these kind of discussions, but in this commentary, he was pretty conservative in the way he framed it.
That's right. While Trump did leave the door open to discussions continuing, he did seem to moderate his tone a bit more and express a little less confidence that a deal was at hand. That's hardly surprising, given that there have been several rounds of talks recently, all of which have ended inconclusively. Moscow, throughout this process, has stuck to hardline demands that Kyiv will not accept and has shown little sign of backing away from those demands, begging the question, how do the two sides reach a consensus? For now, we know that Witkoff and Kushner, who are obviously just in Moscow, are set to meet with a top Ukrainian negotiator today in Florida. They'll likely discuss the outcome of the talks, the next steps. But what's interesting here is that the next steps may depend on Trump himself and whether he decides to apply pressure to either side to back away from their current positions to try to reach a deal. And if he does apply pressure, what is that pressure and to which side does he apply it? Those are kind of the key questions coming up next.
OK, so we watch for those talks then between the Ukrainian side and their US counterparts potentially in Miami. Meanwhile, the Russian president heading to India. This is a fascinating and long-running relationship between the two sides, both on the trade front and energy, but also defence as well. What is likely to come out of this, and how does that tie into the pressure that the US is putting on India?
You're right. It is a very important relationship for both sides. India has had ties to Russia since the Soviet era. Those have been obviously defense and economic ties. Politically, this is a key moment for both leaders. Vladimir Putin is basically defying Western efforts to isolate him. He's continued to travel, and this will allow him to show that he is not isolated. Whereas for Prime Minister Narendra Modi, it helps demonstrate his independent foreign policy path. Trade is on the agenda. It's very important for both sides, especially in the energy realm. Since the 2022 invasion, Indian purchases of Russian oil have surged, but those are complicated by U.S. sanctions. So those are likely to come up. And as you said, if they do reach a deal on trade, defense purchases, or energy, that could complicate India's own negotiations with the U.S. toward a trade deal, as New Delhi tries to get out from under those 50% tariffs that Trump has imposed, citing those purchases of Russian energy. So a very delicate balancing act for Modi up ahead.
Greg Sullivan, thank you very much indeed. Russia government editor with the details there as we watch that visit by Putin to India tying into this, oil holding a modest gain as traders watch that meeting, of course, between the two leaders of Russia and India and the ongoing Ukraine peace talks. Let's bring in then, for greater implications, the broader implications for the energy markets, Bloomberg's Stephen Stupczynski. Stephen, what are you watching for? What are the main dynamics within the oil markets at this point? Oil is kind of relatively muted. I see LNG prices are soaring. What is standing out to you within this commodity complex as we tie in the geopolitics?
Yeah, I mean, I think certainly the outcome of this meeting or the outcome of a potential deal between Ukraine and Russia has been on the top of everyone's mind over the last week. That's why we saw sort of a come down in prices, because, yes, if we do get some sort of deal, maybe there will be an unwinding of sanctions, or the risk of more sanctions on Russian oil and gas could be removed, right? We had those kind of surprise sanctions from the Trump administration on Lukoil and Rosneft, and that is reducing the amount of barrels from those suppliers that can go to their primarily Asian customers, and they're kind of scrambling to find something else. A peace deal would kind of get that out of the way. Now, it doesn't look like it's in the cards at the moment, but I think other things that folks are focusing on quite closely, of course, has been OPEC Plus has kind of confirmed their pause for increasing output in the first quarter. Also looking at how we're going to see with U.S. inventories, there has been a slight inventory increase in the U.S. as expected for crude, but it wasn't as much as people were expecting. And also or was below what people were expecting. And then likewise, we're also looking at Chinese demand, right? So obviously the Chinese demand situation is the big story. They're the biggest buyer of crude, and they haven't really been living up to what the market, I think, was expecting them to do over the last few years. Yes, there was some buying earlier in the year that was mostly for stockpiling purposes, but we're expecting that to sort of deteriorate or essentially slow down over the next few months. And then we're going to be flipping more into a glut situation, according to analysts from the IEA to Goldman. We are going into a market that is much frothier than it was before, and that is going to weigh on prices. So if you add a peace deal into that and more Russian flows into the market, that just adds to this oversupply narrative as well as a bearish market.
Yeah, JP Morgan telling me earlier that they see $50 a barrel next year. They are short oil for some of those reasons. Stephen, when we think about this meeting then between the two leaders of Russia and India, the pressure is clearly on India with these very high tariffs that the US administration has imposed because they are purchasing Russian oil. Have they slowed significantly the purchase of Russian oil? What are the flows looking like right now between Russia and India?
Well, if you ask the Indian refiners, yeah, they are slowing down, and they are looking to buy. Now, you have to look at there's sanctioned Russian oil and there's unsanctioned Russian oil, and we've heard, Bloomberg has reported, we've heard from our sources that the refiners are looking to shift away from those sanctioned barrels. So we're talking about Rosneft and Lukoil here. Now, at the same time, they are still indicating that they'll continue to buy the unsanctioned Russian oil. So there's this interesting sort of act that they want to play, because Russian oil, even if it's unsanctioned, comes at a pretty good discount. And these buyers, they want discount, they want the best prices possible. So they're trying to sort of thread the needle between the geopolitics of the situation, which is sort of staying away from blacklisted oil, while also being able to get the best deal possible. And Modi is meeting with Putin, and it is something that clearly he wants to strengthen that. Putin wants to strengthen that relationship, the energy relationship between the countries. So that's something that the government's going to have to deal with as well, as the White House closely watches.
Bloomberg energy reporter Stephen Stupczynski, thank you for that update. We continue to, of course, to monitor that meeting and that visit by the Russian leader to India. Let's stay within the commodity space, but focus on some of the inputs in the iron ore space and the metals as well, because Rio Tinto has announced a string of cost cuts just in the last few minutes or so in a strategy overhaul. The world's second largest miner also outlining plans to release $5 to $10 billion from its existing asset base. Let's bring in Bloomberg's metals and mining reporter Martin Ritchie with the details. Martin, what has stood out to you? The lines have been crossing in the last 20 minutes or so. What has grabbed your attention?
Yeah, that's right. This is very much breaking news, so we've not had a huge amount of time to go over the document. But what really stands out, I think, at first, is that there is no big bazooka, if you will, in this. I think a lot of people were maybe expecting some really big numbers, perhaps on headcount reductions or cost reductions here. It's not clear that that's what we're getting at the moment. Rio talks about, as you said, releasing $5 billion to $10 billion of cash from existing assets. It's talking about annualized, I think, productivity gains of $650 million by the end of the quarter next year, and 4% reduction in unit costs by 2030. But all of those are kind of subject to footnotes, which we'll have to look at a bit more carefully. And Simon Trott, who's the CEO, he's been in the job for 4 months or so. People are looking for him on the big strategy. He's already streamlined the business somewhat over the past few months, and he'll be speaking to the media in about 5 minutes from now. So we'll be tuning into that for more.
Martin, I want to get your take on what's happening in copper as well. So that's the update from Rio. We continue to monitor it, of course, a stock to watch at the open. Copper currently a little softer, 11,470. Goldman Sachs saying the breakout above 11,000 for copper is not going to be sustained. What is going on? What are the dynamics that are kind of front and centre around the copper story right now?
So as you know, a lot of focus on the supply side in copper in recent years. You have this strange dynamic now where, because everyone thinks Trump is going to put import tariffs on copper imports to the US next year, there's a lot of metal flooding to the US, and the idea this is going to leave the rest of the world short, and that's what's kind of driving up the price at the moment. And in the past few weeks, yesterday there was a big outflow of metal from London Metal Exchange warehouses, presumably to the US, and that's a sort of indication that kind of tightness is happening. But there are some skeptics about this as well. Goldman said, look, the world has enough metal. That flow to the US could be fairly short-lived. It could be balanced by, tightness elsewhere in the world. So we need to see what happens to those flows from LME warehouses in the coming weeks to see who's right.
OK, Bloomberg's metals and mining reporter Martin Ritchie, thank you for that update. Coming up, the role of AI in the future of medicine. We're going to switch focus. We're going to speak to the co-founder and CEO, Glenn Gowers, of Basecamp Research, backed by Nvidia. That's coming up next. This is Bloomberg. Let's bring you some breaking news right now from Cambricon. It is a major producer of AI accelerators and chips in the Chinese market, and with aims now to triple chip output to replace Nvidia in China. That is a significant ambition. It comes, of course, after Jensen Huang, the CEO of Nvidia, said that you need to continue to compete, of course, in the Chinese market. He's been making that case in the halls of power in Washington. Of course, he's been making it in front of President Trump as well. This is a reminder that China is catching up. It's not quite there in terms of the cutting-edge semiconductors, but it is catching up, and Cambricon is a significant player in that place. Again, Bloomberg reporting that Cambricon Technologies over in China plans to more than triple its production of AI chips in 2026, aiming to wrest market share from Huawei Technologies in China and fill a void left by Nvidia's forced exit. And we need discussions are ongoing right now in the US and in Washington as to how much access, if at all, Nvidia will be getting in the future to that Chinese market. Speaking of Jensen Huang, in September, the Nvidia CEO announced plans to invest £2 billion in the UK's AI industry. One beneficiary is Basecamp Research. The London and Boston-based AI biotech firm has raised over $85 million and has created what it describes as the world's biggest database of biological data in the world. The company uses the data to design proteins with the potential to develop new medicines. Joining me now is Glenn Gowers, co-founder and CEO of Basecamp Research. Glenn, thanks for coming to the studio bright and early. So you have this backing from Nvidia. You guys seem to be doing something that is out of the box in terms of collecting data that hasn't been collected before, but also building your own models with potential significant impacts for therapeutics. Just briefly explain what it is, what the proposition is. What are you guys doing, just briefly, and how it sets you apart?
Of course. We're building curative therapeutics, and this is really a new era for medicine. We've been in the era of small molecules to now biologics, where we are today, and the future really is the ability to design cures from scratch, knowing what's wrong with the patient and designing interventions. This requires AI and huge foundation models that understand how to read, how to write DNA, how to design these interventions. And this is an incredibly complex process. We need entirely new models and therefore entirely new data sets to support those models built from scratch. That's what we've been doing.
Big Pharma's not already doing this?
Not at all. No, they are, of course, doing work in curative cell and gene therapies, but hampered by many different problems, from the costs to the lack of predictability to the kind of length of time it takes to develop these therapeutics. And this is exactly what we think and are proving that AI can have a huge impact in.
So you have more than 10 billion novel protein sequences. What is practically involved in collecting that data?
Sure, it's actually 12 billion proteins that we have now. We're growing very, very rapidly. In collecting that data, we have to go to its source. We need to map all of evolution, where it lies. This is soil, air, water, in 28 countries around the planet, 5 continents, and that's where we're working on the ground.
That sounds incredibly labour-intensive.
It is incredibly labour-intensive, yeah. It's taken us 5 years to build this, with the investments of $85 million to this date, to build this foundational data set, but the need couldn't be greater and the importance couldn't be larger.
And you're looking specifically to address a gap when it comes to more complex genetic diseases that maybe Big Pharma and other drug companies aren't meeting right now for all sorts of various complex reasons. How much progress have you made? What kind of timeframes should we be thinking about in terms of actually getting a drug to market based on the kind of work that you and the team are doing?
Sure, of course. One of the core technologies we're working on is programmable gene insertion, the ability to edit the genome very rapidly in very precise ways. To give some example of how long this could take to develop, even today there was an example recently, a baby called baby KJ. It took 9 months from diagnosing the patient with a genetic disease to designing an intervention to cure that disease in that 9-month period. And that's with today's technology. I think we can get that down to perhaps even a single handful of months, maybe even 3 months.
And to be clear, in terms of when we start to see drugs on the market, is this a this decade story, before 2030, that we start to see drugs on the market that are based on your models and your data sets?
I absolutely believe within a decade we'll see that.
Yeah, OK, and we have to have regulators to work through that in terms of clinical trials. What about partnerships with Big Pharma? What is your relationship with the kind of AstraZenecas and GSKs of the world?
Yeah, of course, we're in active discussions with many of the large pharma companies, precisely for this reason, that they want to move into cures. You know, we don't want to be treating symptoms of diseases, we really want to be treating underlying causes, and that's really at the foundation of the entire pharmaceutical industry. And so we're in active discussions with many of them.
On the commercial side, where are you seeing the strongest potential commercial uptake of some of these solutions?
Yeah, particularly around cell therapies and gene therapies. And these are incredibly complex medicines, both from the design and the manufacturing. And this is really where we have the largest benefit today in both of those steps.
And how do you turn this kind of into revenue at scale for the business?
Yeah, we're talking about medicines. We're talking about cures that treat people from diseases and make them unreliant on healthcare systems, etc. And so the commercial demand for this is incredibly high from all of these different patient groups around the world, which many of them today have no cures, no treatments for, and really tens of thousands of genetic diseases and cell therapy. These are things we want to work on.
How much of a headwind is ethics and privacy when it comes to data in different jurisdictions? You're traveling all over the world. You have teams collecting all this data in different regions. How do you navigate that complexity?
Yeah, of course. We need to map the provenance of all of this data and have access and benefit-sharing partnerships negotiated with every country that we work on. This is actually something that we have pioneered. We do a lot of work with various different groups at the UN to demonstrate that this is possible at scale. Mm-hmm. You can build these partnerships with governments and institutions around the world where we can gain this data and, in return, share benefits of the commercialization of that data.
And Nvidia has invested, is that right? They have backed you, is that right? The process
we have collaborations with Nvidia at the moment, and of course with that announcement back in a few different months ago.
Okay.
Yes,
How important is that support?
Incredibly important, that support, because we are training enormous models on all of this data that we have here. That is not a simple task. And of course, we're a team of 50 people based between London and Boston. We benefit from working with the best companies in the world in scaling those models on the technical side.
Is the UK benefiting from a brain drain from the US when it comes to research and science to the UK? Are you seeing that?
We're certainly seeing a great depth of talent in the UK, specifically around applied AI, and that's really because of the depth of the academic talent we have here. We do see a good fluidity between the US and the UK. Of course, we hire from both of those geographies, in addition to many others, and really seeing the UK going from strength to strength in this matter.
And the government's doing enough to support your business and others like it in the ecosystem?
They're doing a good job, certainly with that announcement with Nvidia and having Keir Starmer on stage sharing that announcement.
More they can do.
There's certainly more than they can do here, and I think we are really just in the foothills of the potential of AI in this industry, and the UK, with our academic depth that we have here with top universities, there's a long way that we can go in terms of.
Glenn Gowers, thank you very much indeed. Co-founder and CEO of Basecamp Research. Really fascinating in terms of the work that's being done there. There's a lot more coming up. Stay with us. This is Bloomberg.
The tasks within our jobs are going to be dramatically enhanced by AI. Some jobs will become obsolete. New jobs are going to be created, and every job will be changed.
OK, the CEO, Jensen Huang, speaking there, of course, after and at a time when he was meeting with President Trump as well in Washington, D.C. As he talks about the impact of AI on jobs, some will become obsolete. He says many will become enhanced. All of them will change. Have a look at what happened in terms of the Mag 7 versus the Russell 2000. Yesterday, there was this significant gap. But this actually goes back into the early part of November in terms of the divergence. It really becomes pronounced around the 20th of November, and you see that crocodile mouth shape in the chart here, with the gains coming through for the Russell 2000 on these expectations. That is the blue line, of course, the Russell 2000. Expectations that you'll get that rate cut and a more dovish Fed. So the rate cut priced more than 90% for next week, and that is supporting those mid-cap stocks versus Mag 7, which has really stalled out around here on concerns around AI valuations. You saw that very pronounced yesterday. The Nasdaq 100 gained yesterday, but only about 0.2 or 0.3% versus almost 2% the gains coming through for the Russell 2000. So if that dynamic continues, and whether or not that is an opportunity as investors look to rotate potentially out of Mag 7 into some of those mid-cap names. Let's flip the board and have a look at the broader jobs picture, because you did have that private payroll data coming out yesterday, ADPs, and that did lead to increased bets on Fed rate cut bets. So it ties back in to that story around support for the Russell 2000 stocks. But this is the concern. 32,000 was the number of jobs that were eliminated in the month of November, a contraction of 32,000. That's the worst print that we've seen since November of 2023. And as Valerie Teitel has been telling us, it's the companies with 50 employees and less that saw real pressure in terms of jobs being eroded there, and that will be a concern that arguably ties into the thinking, of course, of the FOMC. On the jobless claims story, let's flip the board and have a look at what's happening here, because, in fact, while companies are not firing maybe as aggressively as some had thought, we have that ADP data, of course, that puts a bit of a question mark around that. The jobless claims data shows us that those who are out of work for longer are claiming for longer. That is a problem. The longer you're out of work, of course, getting back into the jobs market is a challenge. Continuing jobs claims, that is the blue line, and that is the problem in terms of that continuing lack of work for many employees. But companies not firing maybe as aggressively as some would have thought. You can get all these details, of course, on the terminal. The opening trade is up next. This is Bloomberg.